The rise of financial dynasties, the names you don't see in the headlines. When people talk about power, they usually point to presidents, prime ministers, parliaments, or faces that appear on television every day. But real power rarely needs a spotlight. It doesn't need elections. It doesn't need approval. It only needs to exist long enough and deep enough to shape the rules of the game. In modern financial history, there are families who never held political office, never ruled nations in the traditional sense, yet influenced the flow of money, war, public debt, and the fate of empires. The Rothschild family is one of those names. What matters is not how rich they became, but how they built power, quietly, across borders, and in a way that was nearly impossible to replace. This family did not rise by inventing a product. They did not conquer land. They rose by controlling capital flows at moments when Europe was tearing itself apart through war and crisis. It didn't begin in palaces. It began in a crowded Jewish quarter in Frankfurt with a man named Mayer Amschel Rothschild. He wasn't nobility. He wasn't a general. He was someone who understood one thing most of the world had not yet realized. Whoever controls financial information and credit controls the future. Instead of building a single bank, Mayer Amschel did something far more strategic. He decentralized the family's power across multiple financial capitals. His 5 sons were sent to 5 key cities: Frankfurt, London, Paris, Vienna, and Naples. Each son wasn't just a representative, he was a command node in a cross-border financial network. They were connected through letters, codes, and absolute family loyalty. While nations were divided by borders and war, the Rothschild network operated as a single organism. This is the critical point. When governments needed money to fund wars, they couldn't wait for taxes. They needed capital immediately, and the Rothschilds provided it. Money doesn't fire bullets, but it decides who gets to buy them. During Europe's wars of the 18th and 19th centuries, especially the conflicts surrounding Napoleon, the family didn't pick sides based on ideology or patriotism. They sided with cash flow. They lent money, moved gold, guaranteed war bonds, and handled international payments. If a government won, it paid its debts. If a government lost, it still paid its debts, just under different terms. Either way, the debt survived, and the lender kept their position. That's the fundamental difference between military power and financial power. Armies can be defeated, territory can be occupied, but debt doesn't disappear when the battlefield goes quiet. It follows the economy into the post-war period and shapes policy for decades. The Rothschilds understood this early. They didn't seek to control governments, they made governments dependent. This dependency didn't require force, it was built on efficiency. Once the Rothschilds proved they could raise capital faster, cheaper, and more reliably than any alternative, governments stopped having real choices. Another critical detail often overlooked: the Rothschilds weren't just lenders, they were information brokers. Before the internet, before global telegraphs, receiving news days earlier could create massive advantage. Their family network gave them early access to battlefield updates, political shifts, and financial conditions, often before governments themselves. Information became an asset. Money followed information. Their power didn't come from crude market manipulation. It came from designing a system where they became an indispensable intermediary. If money needed to move across borders, they were there. If governments needed to issue bonds, they underwrote them. If gold needed secure transport, they arranged it. When you sit in the middle of every major transaction, you don't need to issue commands, you only adjust terms. This creates a form of power far more refined than traditional political authority. No speeches, no decrees, just interest rates, maturities, and conditions. A government can talk about sovereignty, but when the treasury is empty, sovereignty negotiates with capital. The Rothschilds also understood the value of staying invisible. Unlike modern billionaires who chase publicity, their influence relied on discretion. the less attention they attracted, the harder they were to attack politically. In many periods, the Rothschild name barely appeared in official records, even while they stood behind the largest financial operations in Europe. This wasn't coincidence, it was strategy. Sustainable power doesn't need public recognition. Another key factor was how they preserved power across generations. Instead of fragmenting wealth like many rich families, they maintained tight family structures, internal marriages, and centralized control. The goal wasn't fame, it was continuity. They didn't chase short-term profit. They focused on long-term positioning inside the financial system. That allowed them to survive revolutions, regime changes, and economic collapses. Empires fell, debt remained. And where debt exists, financial power follows. The Rothschilds never needed to rule a nation. They only needed to ensure that whoever ruled would need credit. This is a model of power rarely acknowledged in surface-level history. We're taught about kings, battles, treaties. We're rarely taught to ask, who paid for all of it? The answer is usually not in textbooks. It's not on front pages. It's in ledgers, loan contracts, and cross-border financial networks. The Rothschild family was not the only one, but they were the earliest and clearest example of modern financial power, a form of influence that needs no army, no flag, yet can shape the fate of millions through decisions that appear invisible. Once you understand this, history looks different. Not who won the war, but who financed it. Not who took office, but who funded the machine that kept it running. And this is only the beginning of the story of financial dynasties. The rise of financial dynasties. The names that never make the headlines. European and American financial tycoons. Part 1. When people talk about global power, they usually look toward nations, political institutions, and leaders who appear before the public. But behind that visible layer exists another level of power, quieter, more durable, and far harder to replace. This is the power of financial tycoons. These are not wealthy individuals in the ordinary sense. They do not merely own assets. They control the direction of capital, credit, and risk on a national and transnational scale. They do not need to govern. Governments adapt to the financial conditions they set. In Europe and the United States, this class of financial power rose alongside modern capitalism itself. But unlike industrial entrepreneurs, they did not create value by producing goods. They created power by controlling capital. What unites these financial dynasties is not nationality, but mindset. They see the world not as a political map, but as a massive balance sheet. To them, a nation is not a symbol of sovereignty. It is a financial entity with revenue, expenses, debt, and default risk. During the 19th and early 20th centuries, as nations industrialized at breakneck speed, the demand for capital far exceeded internal savings. Railways, factories, wars, urban expansion all required money long before they produced returns. That gap is where financial tycoons stepped in. Unlike politicians, they did not need speeches. Unlike armies, they did not need weapons. Their tools were credit, interest rates, guarantees, and time. In Europe, financial power developed in an environment of constant imperial competition. War was not just a military conflict, it was a financial equation. Whoever could sustain cash flow the longest held the advantage. And at that point, financial tycoons became indispensable partners of the state. They were not on the battlefield, but they decided who could stay on it. In the United States, the context was different. There were no ancient dynasties, but there was a rapidly expanding financial market. The rise of banking, bond markets, and later stock exchanges gave birth to a new class, those who did not produce but allocated capital. This is where American financial tycoons emerged. They did not need noble titles. What they needed was access to large pools of capital and the ability to shape market confidence. Confidence is the core asset of finance. When markets believe an individual or institution can underwrite, mobilize, or stabilize capital, power concentrates automatically. No law needs to grant it. The market does it voluntarily. This is where financial power becomes both dangerous and sophisticated. Because it is unofficial, it is difficult to regulate. Financial tycoons do not face direct political accountability, yet their decisions can affect millions of lives. When they withdraw capital, economies contract. When they flood markets with capital, bubbles form. No announcement is required, only a shift in cash flow. Another shared trait of European and American financial elites is that they rarely operate as isolated individuals. Their power is embedded in institutions, investment banks, trust funds, insurance companies, or tightly connected family networks. This structure provides protection. When crises occur, individuals hide behind institutions. When investigations arise, responsibility is dispersed enough that no single actor holds the whole burden. On the surface, they are businessmen. At a deeper level, they are architects of the financial system. They understand that money does not need to remain in their possession. What matters is the authority to decide where it goes, when it moves, and under what conditions. Ownership is static. Control is dynamic. That's why many financial tycoons do not hoard cash. They keep money in constant motion through loans, bonds, and strategic investments. Each cycle multiplies influence beyond the original amount. A dollar lent at the right moment can determine the fate of a company, an industry, or even a nation. European and American financial elites also learned early that lasting power does not come from confronting governments, but from becoming indispensable partners. When states need funding, they step in. When economies collapse, they stabilize the market. In return, they gain policy influence, legal privileges, and, most importantly, early access to information. In finance, information is not just data, it is time advantage. Knowing about an interest rate decision, a bailout, or a regulatory shift even days in advance can generate massive profit. And that profit does not come from labor, it comes from position. This class rarely speaks about power. They speak about markets, stability, confidence, and growth. But behind these neutral terms are decisions that shape society at a deep structural level. When capital flows into finance faster than production, economies change form. When debt grows faster than income, societies become fragile. But these consequences often appear years later, long before the decision-makers have moved on. That is the defining feature of financial power: delay. European and American financial elites did not build dominance through a single dramatic move, but through thousands of small, legal, and reasonable decisions made over time. Only in hindsight does the full picture become clear. And once that picture emerges, the system is already too large to reverse easily. This is only the foundation. In the next sections, the focus will move deeper into specific groups, specific mechanisms, and the ways financial dynasties shape the modern world without ever stepping into the public eye.
Follow, subscribe, and share the channel to gain new knowledge and grow every day.